Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Wednesday, May 29th, 5:26 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Revere Roundup Daily Market Insight video. Market state, we are in an uptrend since May 6th, an uptrend that's getting weaker unless you're in the leading stocks or focused on the S&P 500 or NASDAQ 100. Let's check the trend gauge over here. Market leadership, they're holding up fine, but deterioration under the surface in mid cap, small cap, and the Dow, and also non-tech indexes is starting to take a toll. We're going to show the RSP index later, and if that's what the S&P 500 looked like, several of these green arrows would be red. Dow, multiple closes below the 21 and it's rolled over. Mid caps and small caps now also multiple closes below the 21-day moving average and starting to roll over. That's our short-term trend indicator. NASDAQ 100 and the S&P 500 just fine if you look at those two indexes, which are propped up by big tech names. You wouldn't have any clue that there's anything wrong with the market, but there is certainly some bifurcation going on. And to make that worse, our medium-term indicator, the 50-day moving average, three of the indexes are now below that level, the Dow, mid caps, and small caps. Long term, and the market never gets into serious trouble unless we break the long-term 200-day moving average, but all five still above that level. So what happened today? Right, first thing in the morning and overnight, yields popping again. So big gap down in the indexes, no further movement downward, but no bounce either. We just traded tight in a very tight range for 5 hours. Uh, Leaders holding up just fine. We're outperforming in-house most of the day and certainly into the close. But certainly some concern with what we're seeing with those three indexes that I mentioned, and also with yields rising. Here are the numbers on the day. The 21 over 21 list led by Abercrombie and Fitch, up 24% on earnings. If you exclude the high and the low, the average was up 0.19%. If you keep the high and the low in there, up 1.12%. So we like to give a full picture of what's actually going on in there. So positive and certainly outperforming the indexes, but not as strong as the full 21 if you exclude ANF. But still 10 up, 10 of the 21 up on the day. The big eight just barely negative. This is another thing keeping the S&P and the NASDAQ propped up. RG8, this is our 8 growth ETF composite. This is a better visualization of what's going on broadly in non-AI data center or restaurant type names. There are a couple others that are standing out, but those two sectors certainly carrying the weight for a bunch of the leading names. S&P 500 gap down 0.75% and basically closed right there. A weak close today. Equal weight, worse. And this again speaks to the lack of breadth, down 1.2%. NASDAQ 100 down 0.7. Equal weight, worse, down 1.1. The Dow, nowhere to hide, continues lower and underperforming, down 1.06. Mid caps also weak, down 1.3. Russell 2000 weak, down 1.5. Global 60/40, not a good day, down 0.77%. The leading stocks that we owned buffered us to the downside, still down 0.28%, but nowhere near as bad as the indexes. And we're going to take a look at a couple of charts and a couple of charts that aren't in the 2121 list that certainly need to stand out. So let's start with that RSP, S&P 500 index. And again, if the S&P 500 looked like this, as I said, we would be very lightly involved in the market. So here was that big negative reversal on the 23rd. Tight inside day. S&P 500, I've been showing it on a 15-minute chart, holding that level, Big break to the downside today. So let's take a look at the RSP on a 15-minute chart. Uh, you can see the breakdown and absolutely no recovery whatsoever. Now let's go to the S&P 500. Much better, still at the bottom of the range. This is where the gap up was, the move up on CPI. And then we went tight. Let's draw some lines. We went tight. We had a failed breakout. We had a failed breakdown. Now back into that area below the 52.83 to 86 level that had been acting as support. So this brings the 52.57 lower range uh, into consideration and into the discussion. If I go to a 30-minute chart here, you can see very clearly the gap up here on that CPI day and how 5250-ish, 5250 to 5256 is a critical area. If you go out to the 60-minute, well, let's go to the daily. We're pausing on two of these last four down days right at the top of this 52.65 prior high. So you look left to be right. This was an area that acted as resistance. We got above it. We're coming back into it, and it's acting like support, but it really needs to continue act like support. 52.50 on the downside uh, needs to hold. Below there, we start getting into all of this area, which was the leg down and then the recovery, and that makes it a complete failed breakout. If we get back into that, particularly, we got the 21-day moving average there as well. That needs to hold. So there's several levels of support that we're monitoring. 75% of stocks in the market will follow the direction of the overall indexes. Put an asterisk next to that because equal weight, the RSP, they're already breaking down. There certainly is fewer and fewer stocks that are holding up, but still I've got a list of easily 50 that are very strong, showing leadership quality, good fundamentals, and people aren't selling them. Doesn't mean that they won't start selling them tomorrow. When we saw the gap down this morning and the fact that it was breaking below that level on the 15-minute chart that we've been referencing, this 52.85-ish area. We got a list of our hedging ETFs, our inverse ETFs in various sectors out, and we're prepared to pull the trigger if we saw further deterioration, but we didn't. We just chopped and leaders held up, so there was really no reason to make any changes to the portfolio. Not to mention one of our holdings with a big gap down, but we survived the gap down and a very strong uh, intraday action on Kava ended up 7% on the day after being down at least that much. We'll take a look at that chart momentarily. So there's the S&P 500, plenty of support levels right below here. 9-10 day consolidation now. We need to hold to the downside, and we need to see some broader participation out of not only the S&P 500 but also mid and small caps. If you look at the individual index charts, the 11 components, the spiders, the 11 spider sectors, only utilities and tech look fine. Industrials, add those to the list, and materials, really all of them, including financials, the ones that are acting uh, pretty ugly. So there's the S&P 500. Let's go to the NASDAQ 100. Pretty similar story here. This 15-minute chart, quite healthier, showing the relative strength of the S&P 500 that we've been talking about. We would be down in this area if this was showing the same relative strength or the same pattern as the S&P 500. So we're still above the 8-day moving average there. And you can see the 21-day coming up into this support level. In fact, it's the pivot of this flat base that we just broke out of 2 weeks ago. Now to the bad and the ugly. We'll start with the Dow. Just continuing to waterfall lower, slice through the 21, broke the 50, now further down to the 50, coming into a pretty big support area here around this 38,000 level. So maybe the Dow finds support there, and some of the Dow stocks that are holding up better can contribute to the overall recovery. You can also see over here from back in December and January. This was a big support level as well, which we're coming into now. So we're trying to tick boxes on the pluses and the negatives, present the full picture. Obviously, the relative strength on the Dow has been terrible all year, but we are coming into a big support level here on the Dow. Let's go to mid caps. The S&P 400 gapping below and closing below and near the bottom of the range, below the 50-day moving average, which is now flattening out. The 21-day has rolled over for 2 sessions now. So this, and also look at the relative strength line, just continued deterioration here, but coming into a pretty big support level here at this 2,900 level, which is where we broke out over here, pulled back, undercut, got back into the chop zone before breaking out above there. But this looks like a really big double top here, although we didn't make a higher high. And now breaking and gapping below the 50-day moving average. Let's go to the Russell 2000, breaking below the 50-day moving average as well. 21-day starting to roll over, coming into, however, this 2020-ish level of support. Really a pretty big range here if you get into here. So after 2 harsh days down like that on all 3 of those indexes that we just shown, that's the Dow, mid and small caps, they are coming into potential support areas. If leading stocks held up well while the market is deteriorating, if the broader market looks to continue, the question will be, will money take profits from those leaders and fall into some of the quote unquote value, flow into the quote unquote value of mid cap, small caps, and the Dow, or will it continue to outperform and lead the market higher? That's one of the things that we'll be watching for. Everything's on the table. We don't predict, we interpret. And we don't really like what we're seeing the last couple of days, but leading stocks are the exception there. So those are the 5 major indexes. Let's go to the VIX. VIX with a pop, not surprising, up 10.5%. That's pretty strong. Above the 21-day moving average, which had been acting as resistance, still below that 16 level, which is where the market has been outperforming going back to December. So this is certainly something we're keeping an eye on. The US dollar had been weak, but strong today, coming back up to kind of a resistance level here. And strong dollar doesn't help stocks, up 0.5% today. How did this translate to the precious metal market? Gold down 1%, gold stocks down 2.5%, sitting on the 21-day moving average, and silver strong most of the day, only down 0.25%. Bitcoin via the IBIT down 1.7%, tightening up today, comparing it to the range of the last week or so. On to bonds. Broad bond index gapping down, staying down. Prices down, that means yields up, down 0.3%. TLT, the broad, gap down, stayed down, down 1.21%. This means you're going to see the yields tick up. Here's the long bond. Second big handle day, gap, close at the highs, up 1.9%. And the 10-year, also a gap up and close near the top of the range. This up 1.8%, certainly not good for stocks, although we did benefit by owning TBT and buying that yesterday. Bought it kind of as a hedge, but leaders continued to outperform even in the face of rising yields today. That's our inter-asset correlation. Let's go to the tail of the tape. So believe it or not, there is a 0% chance of a June rate cut, a 1% chance of a June hike. I had heard people mentioning possibility of a hike, but when you actually see it priced into the futures, that's different than just talking heads mentioning it. Friday, PCE inflation data, we get that. That will probably play a big role into which direction the indexes break out of this, particularly the S&P, this 9-10 day range that we're in. So that's something we'll be keeping an eye on. Expectations still positive, but really more positive than neutral with the overall weakness, although again, the S&P and the NASDAQ 100 holding up fine. From a sector standpoint, retail actually finished negative by the end of the day. So 11 out of 11 sectors, S&P sectors down. I like to note it like this when it happens. And led to the downside by semiconductors, oils, banks, utilities, real estate, and gold stocks. No changes to the portfolio, so adjusted beta staying at a 1.29. There are a couple things going on that really keep us from adding much exposure. If anything, we did add some kava for some new money that came in that didn't have it or didn't have the full allocation of it today, but overall for existing clients, no changes to the portfolio. The fact that we're under the 8-day gives us a little bit of pause, and the lack of breadth certainly giving us pause, not to mention 3 indexes below the 50-day moving average. So bottom line on the day, big gap down, then we went tight, yields higher, Dow, mid, small caps breaking below the 50-day, leaders holding up A-OK. And let's take a look at some of those leaders. We're going to go outside the 21 over 21 first. So let's take a look at some things that caught our attention earlier in the week and something that we want to make sure we get on the radar here. So ELF had a big volume gap up, and it's consolidating over the last 3 days. And this is a flat base trying to get into more of a cup-ish look as it rounds out the right side. But good earnings numbers for there. And this is really a stock we haven't played very well at all, but keeping an eye for a possible entry in there. Something else that is on our radar, Bros gapped up on earnings, continued higher, had a harsh pullback after a downgrade, bounced at the 21 and had a good day today. Let's see. That's really, I thought there was more I wanted to show. But those are really the only two. No, there was one more. Hood. They announced a stock buyback, and this is back up to the top. We got shaken out down here on this under the 50-day and 21-day moving average, but it's recovered, putting in a bit of a handle and up on some nice volume today. So let's go to the portfolio now. And there's a couple of these have earnings after hours that we're going to comment on when we get there. So let's start off with Abercrombie. Just the overall negative tone of the market kept us from taking an entry in here, and this just kept grinding higher all day, unfortunately. But now we've got our high volume close, and we can reference it when the moving averages start to catch up to it. So this was the leader of the 21-21 today. Kava, look at this bar. This is everybody that wanted out got out, and then it was bought with both hands. Look at this gap down and then big flush. You can see this reference over here. People had stops all under here, and the algos were only too happy to collect them, send it down near 74, and then boom, a big slingshot to the upside on really heavy volume. This, as long as the market stays strong, this is certainly something that wants to be a leader since it broke this downtrend line about 6 weeks ago. Serious relative strength at a new high along with price. You always like to see that. So that's number 2. PBT, this is the interest rate hedge that we're benefiting from. So up nicely on that. Nutanix after hours, here's a problem, down 9%. The CEO was quoted as saying it's taking longer to close big deals. Market didn't want to hear that. So this is in the 66 area, still above the 50-day moving average, but that's not the reaction you want on earnings, obviously. Yeah, still above the 50-day moving average. So we'll be looking to see this is a leader. It does have an AI data center component from the software side. We'll be looking to see if buyers come into this today. TDD, undercutting and reclaiming the 8-day. NVIDIA just fourth day higher high, the big leader. Everybody wants to short it, of course. App continues to stay strong. CrowdStrike, uh, flat after hours. Okta, another security stock, up slightly after hours, but it's had a wild ride, about a 12% range after hours. But this is at least not dragging CrowdStrike down, as it's holding the 8-day moving average and has earnings next week. Great relative strength, too. Pure Storage after hours, this is what we want to see, up 6%. Their CEO says they use a tenth of the power and cooling required of their competitors, and that's showing up in the chart. Remember, quote of O'Neill, it's not the chart that makes a stock go higher. It's or makes a stock double or more. It's the story behind that. And you can see the big gap up on its last earnings report, put in a double bottom base, broke out of that, and continues higher in relative strength, confirming the price action, up 7% after hours. We'll be looking to add to this tomorrow. I'm not going to fly through the rest of these as until something that jumps out at me wants to, but none of them breaking the 21-day moving average. That's part of the story. Micron data center relative strength today. Spotify hanging in there. Howmet, Freeport. There's Bitcoin. Vertiv down 1.85%, below average volume. Data center holding up fine. This was the worst on the day of our holding CEG. Above average volume, breaking the 21-day moving average. Didn't see any news. It's strong. It's volatile. Really not a whole lot to say about that. So what else, what are we looking at tomorrow? Well, certainly after hours, we're we're heading over into the overnight session, down a third of a percent on the indexes, which is certainly uh, not optimal. But we need to see these levels that I pointed out earlier in the video hold tomorrow, and then especially the 21-day moving average. Should we get down into that on the S&P 500? We are only a 0.5% away from the 21 and 1.7% above the 50-day moving average. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Flagship portfolio serves a dual mandate. GROTECTION, grow assets during uptrends, protect them during downtrends. We've got our levels in place. We've got stops on everything that we own. We've got about a 4.5 to 5% downside if all of our stops would get hit. We update those stops every day. And if they're all hit, we will have, since we re-engaged on the 6th, we will have locked in some profits because we're up higher than that since then. So if you're interested in this approach, reach out to us. We'd love to talk to you. And with that, I'm going to wrap it up for Wednesday, May 29th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening and have a great day.